Is Yuri around? Here he is, and then also who else are we? We're looking for Metinvest, one of Ukraine's leading industrial groups, has provided us with the services of its Director of Corporate Finance and Treasury, Oleksandr Lyubarev, who will be Oleksandr, please come up and join us. So Jerome, you're all intimately acquainted with Ukrainian government's Commissioner of Public Debt Management, Yuri Butsa, Metinvest, Oleksandr Lyubarev on my far right, and representing the family office and private banking sector from Fabian Pictet Partners Asset Management, a partner of the firm now specializing in alternative investments in emerging markets, Jonathan Neill on my far left. And where would we be without a representative of the major firm, which some people call the US shadow government, and with its, and others, the vampire squid it's been described by, with its tentacles in every corner of global finance, from Goldman Sachs, credit strategist for emerging markets, Mikhail Galkin. If I can start with you, Mikhail, the World Bank predicts that emerging economies will grow at 4.5% in 2018, an average of 4.7% in 2019 and 20. There's some debate within your firm about whether this enthusiasm should be shared. Your private wealth arm, for instance, says that they're not so optimistic about emerging markets long term. Is Goldman backing this gravy train this time round, or are there varying views, would you say?
Hi everyone, and thank you for inviting me on this panel. Look, I think the commentary made by one of our private wealth division representatives was more referring to the client's intentions to really focus on preserving their wealth rather than trying to make a lot of money. Our view, I represent the trading desk of Goldman Sachs that is involved in emerging markets. We are very, very constructive on EM as a source of opportunity, as a source of investment opportunities, and I'm actually subscribing entirely to Jerome's views expressed here. My most favorite asset class is actually emerging market credit. That is the dollar debt of EM countries. If you build a very simple chart showing the total return from that asset class, you can take EMBI index total return chart, and you will see that you could have multiplied your money 5 times by investing into the asset class in 2000. And what's more striking is the risk-adjusted return, or the so-called Sharpe ratio of this asset class. I haven't seen anything else that beats EM credit. It's very simple. This on average, the sovereign bonds are paying you at the moment around 6% in dollars, and that's about almost 400 basis points, 380 on the spread over riskless curve, and the default statistics, and then the loss of investors in investing in EM has been fairly moderate, if actually minuscule, over the past 20 years. So I find it quite peculiar why people are still, haven't discovered it for themselves. It's probably sad for EM countries that still have to pay excessive interest rates, but it's an amazing opportunity for people that are involved in EM at the moment. And I think, I guess the longer that this market inefficiency persists, the longer people investing in emerging markets will be yielding excessive returns.
And how do you feel Ukraine fits into investors' emerging market portfolios?
Well, Ukraine is clearly a very interesting growth story, and it's out there in the market with a fairly significant amount of debt. It's actually quite a big weight in the index. Look, it's at the moment the market is such where issuers are competing for investor attention. It's almost like a beauty contest. And Ukraine actually looks fairly good within its peer group. I think one technical angle that I mean needs to probably be addressed over time is that Ukraine's local investor base is fairly weak. Local holdings of Ukraine's Eurobonds are close to nothing. So that technical makes yields on Ukraine debt higher than they would have been otherwise. But I think it's a very interesting story, and yeah, I mean, you probably all know that it's yielding you between 7 to 9% at the moment. Thank you.
And that local market that we're talking about, and if I can bring in Mr. Lyubarev from Metinvest, is that local market strong enough for your financing needs for your capex expenditure?
Yeah, thanks. First of all, thanks everyone for being here and inviting. First, and thanks for coming in the morning, for some of you at least. I think that the question here is very simple and straightforward, and one of the colleagues yesterday, Riyad, openly raised this question, and we're all seeing that, and we all recognize that the local market can bring us just immediately, potentially, $20 billion with those funds that people are keeping like in their safe box or keeping short term in the banks. Of course, the thing is that whether people would be able technically and practically to get an access to the corporate bonds or sovereign bonds, whether right now they have an access to sovereign bonds, yes. Whether it is straightforward, no. Whether there are some tax exemptions and incentives, yes. What should we do in order them to invest into the corporates? Well, there are a lot of probably issues here, but we should definitely try to get used to the longer tenor, because otherwise we cannot like just invest for 2-3 months, 6 months, and that's it. So we should create the conditions for people and appropriate creations afterwards for the banks that would be actually the agent, because well, like the person with $10,000 cannot invest like itself directly. So because of denomination and because of many other things, or maybe it could be. So, but in any way, we need to involve the banks, the national bank, we need to involve people, try to persuade them that the long-term strategy in terms of investing in its own country is much better than looking for some alternatives of buying sometimes the mortgage or something like it. And then there is a recourse to real sector companies that can bring a lot of benefit, and they actually can be the partners and investing into the local market. This is the most important for us because we undervalue the role of the local market, because we care about a lot of foreign investors, and this is true and important, but we should care about our own people who would be able to invest into us. And a lot of trust was lost in 2008 and 9, and remember in 2007 how was big the bond market, to some extent of course, comparing to what we have right now.
If I can bring in Yuri Butsa here, is it a case of that Ukraine is actually doing a lot of things right, but it's thrown into the same bucket as those countries like Turkey, which are doing everything wrong, which can actually make Ukraine look worse than it is?
Thanks for this question, and it's an interesting question for us because we are rather small and open in this beauty economy, and in this beauty contest, you know, it's hard to stand out among this crowd, right? So if you look at Ukraine, very traded now, people in this country compare ourselves like to Poland or Slovakia, Romania. So if you look at where our yields are, so we are 200 basis points wider than Nigeria and Mongolia, and 150 probably now from Ghana and El Salvador, and I'm not sure everyone in this room, even actually with all the respect, knows where is El Salvador. So basically, here for us, doesn't matter. It really doesn't matter that much how much good country-specific news we generate, being small. And if you look at us, obviously we have inflation going down and under control. You cannot tell that this country's central bank is under any political influence, and in contrast to other countries, like Turkey is a good example. Here, actually, nobody expects what will be the decisions. They know that the decision of the central bank will be prudent. Deficit is under control. We are running primary surplus for 4 years, right? So we kind of more in this respect, and also we are not afraid of free trade. Obviously, we benefit a lot from DCFTAs with EU, and we try to develop the free trade agreements with big part of the world. But if you look globally, so this doesn't matter much for many of investors, because if something goes wrong with Turkey or Argentina or South Africa, people just sell everything. So you just don't stand out of the crowd, You just, we in the office, besides doing our own job and working like as a policy maker, we obviously sit the same Bloomberg terminal as investors and watch the news coming from the central bank of Turkey, or have to install Twitter in order to follow like what's going to happen next moment, So basically, that's the problem of being rather small in this world, and I would say that that's a challenge. And the only thing I think how you can change that pretty much is to prove by doing like for a rather longer period of time that you should be not in this beauty context, but probably with another peer group and another beauty context.
So how do you do that, Yuri? How does Ukraine differentiate itself and amongst this competition and, as you say, get into a different beauty contest?
It's a long job and it's a tough job actually. If you look at Ukraine, like over the last 28 years, we had more tradition of doing everything wrong than doing everything right. So basically, if you last 4 years, I don't think you can blame us that much for some under-reforming, because the things we changed over the last 4 years, as for me, and I just read recently Financial Times last week, they said that we did much more in the last 4 years than in the previous 24. But you need, there's still uncertainty for how long you can go with this, right? So now when I talk to investors, what I hear from the people that, okay, guys, you are, okay, we trust you, you behave. The next people will come in a year, what will they do, And that's the question that start bothering people. So it's the continuity, which that's the important thing. So I think that the time works in our side here, and basically, if you continue with this speed and if you continue to deliver, I think that should pay off at some point of time.
But we can't escape from the turmoil that you're talking about in emerging markets in general, and I wanted to bring in Jerome. Now that investors are supposedly back from the beach, although I'm sure there's a few relaxing here in Odessa tomorrow maybe, after the long hot summer, are we due a sharp recovery?
Well, I do think it is a bit depressing that, year after year we still have the same sort of knee-jerk reactions. But I think if you strip away some of the hype, a lot of investors get it. And the idea that there is an emerging market crisis, I think, is fundamentally a misrepresentation. What there is some short-term flows which have been obviously particularly strong in two countries, Turkey and Argentina. And pretty much, if you look at Asia, I mean, there's very few countries that are vulnerable, if you like, in the sense that some have a balance payments issue, but we're talking about Philippines, Indonesia, very marginally India. That's it. And every other country in Asia completely unaffected by what's going on. And I think there's similar patterns in other parts of the emerging world. We have to, when we talk about if people are going to sell emerging markets because they're risk averse, what do? They put more money into the place where the risk really is. I mean, that's just daft. And it comes back to this perception of, what are you trying to achieve with your portfolio? You're trying to, and I think a lot of the problems arise with, agency problems. I remember talking to a Californian pension fund, a large pension fund, and he said, yes, Jerome, I understand. We need to put 25% of the portfolio into emerging markets. I get all that, and maybe possibly more. I understand. But unfortunately, and you keep on criticizing us for all being herd-like, but unfortunately, I still have to be in the herd. I can be at the edge of the herd, but I still have to be in the herd. And so there's a sort of gradual, this comes back to your point, there's a very, very large arbitrage in emerging market credit and markets generally, and that is an advantage. It's nothing to be worried about if you're an investor. It's something to take advantage of. And actually, if you're worried about Turkey, or if you're worried about Argentina, go and buy Ukraine. That's the logical thing to do, not to go and put more money into US Treasuries or buy stocks in Italy. I mean, that's the thing I think to tackle head on, is the way people perceive risk and how they think about positioning and managing their portfolio. And I think the message from Ukraine has to be a global message from all emerging markets to stop being so uniform and ridiculously focused on these sort of prejudiced way of thinking. And I have to say, Yuri, the press is part of the problem in this regard. It reinforces this very simplistic knee-jerk reaction to emerging markets, and it's really not very helpful.
More positive signs about Ukraine there, but Ukraine and the US, they're very closely connected, particularly by this man, this lobbyist, Paul Manafort, whose case is currently going through the courts. He advised both President Yanukovych and President Trump in their election campaigns. Now, Yanukovych was overthrown in the revolution in 2014, which many of you took part in, whereas Trump is now challenging both Democrats and Republicans to impeach him, claiming that he's created 200,000 jobs through his management of the economy, that the smokestacks of Ohio, Indiana, and Pennsylvania are burning once more, that the factory conveyor belts are humming, and an impeachment would halt all of this. Are these policies merely providing a sugar high for the dollar and stock market, which will both ultimately be undermined? Jerome.
Well, I do think that when you have very loose fiscal policy and expectations of rising interest rates, you've got a recipe for bubbles. And we can argue at what stage you're at. I think there's also the case that you have a global imbalance which still has led to the dollar being overvalued. The average, if you exclude the period of high inflation in the 70s, the average historical yield for the last 6 decades on a 10-year Treasury in the US is 6%. So that's the neutral position. We have some serious problems with the US economy. I mean, one of the reasons why I don't think you're going to get some of the inflation risks is simply because there are still 39 million people on food stamps. And that's down from 47 million, but it's still an awful lot of people on food stamps. So the idea that the labour market is just fully recovered, and there are different ways of looking at the economy. And I think I sort of have this image, and maybe it hasn't formed in the president's mind yet, where after he gets re-elected and after he has overseen a huge fiscal splurge, and he's at the same time managed to borrow endless amounts of money from the world at very, very low interest rates. And then it all, 1970s style, ends up in an inflation mess, the devaluation and all the rest of it. He's going to have a big grin on his face, and he's going to say, well, I told you I knew about default, and countries default by other means. We've got full employment. We don't have to pay the world back this money in real terms. And I'm smart. I'm much smarter than all you guys on Wall Street. And he'll be right. He'll be dead right. He will be smarter than them. The signs are there that what is going on is unsustainable. And I don't think, if you look at something like the credit, junk bonds or corporate debt in the States, all that the issuance is doing is refinancing existing debt. There's very limited amounts of what you would really call new investment. One of the phenomena of the labour market has been that because of the amount of uncertainty, companies have been very loath to invest in plant and capital. And so they've invested, they've basically hired more people. And that's created this sort of this idea that there are more jobs being created. But they're very poor quality jobs in many cases. And a lot of people are underemployed or semi-employed, or they've given up. As Narayan said yesterday, they've just given up looking. So the labour participation rate is phenomenally low. And yes, from that sort of huge dip, it's now improving a bit. And I'm not going to deny that. It is getting better, and that's a very positive thing. But the idea that suddenly there's been this huge success and it's all, going to be wonderfully rosy, I think, look at the, as I said earlier, if you compare the debt dynamics and the credit ratings and what you're getting paid for it of, say, US corporate debt and emerging market corporate debt, you'll be stunned by the difference. I mean, you've got much lower default rates in emerging markets, much better credit. The debt that's being taken on board is there to grow the companies. So the actual debt to revenue, the sort of debt burden or the affordability of that debt is actually coming down as the debt is growing. And yet none of this subtlety, if you like, is often represented. And the idea that there's a big amount of US dollar denominated debt owed by emerging markets is also a bit of a myth. I mean, these are huge, this is 2/3 of the global economy. And so the ratios don't look at all worrying in many senses. And whereas I think in the US, we do have, I don't want to be partisan here, but I think the solutions to the US are, it's a single country. It's really got very little to do with what happens in Ukraine or anywhere else, fundamentally. And we should stop thinking about everything that happens in the US being so important for everybody else. It's really, they've got their problems, they've got their successes, they have a wonderfully flexible economy, which is great. They've got huge productivity, huge wealth of, in all sorts of ways, and I'm sure they'll do really well. How they get there and the details, why should that matter too much to Ukraine? It really is kind of not the point.
Would you agree with that, Mikhail, that there's too much concentration on what's going on in the US as a determinant of emerging market behavior?
Well, I think market is getting wiser and is becoming more immune to, say, U.S. interest rates volatility when we talk about EM. And just generally, I want to say that I think investors are becoming much more aware of what they're buying. And like, for example, if you look at 2016 and 17, those were the golden years for a lot of assets. But if you bought EM blindfoldedly, and you would have made money no matter what you bought. But this year, phenomenal how the variance and differentiation between the countries this year. You have Zambia that blew up, Argentina, Turkey, Lebanon, and yet you have a large number of countries that have actually done very well in terms of asset prices. So this year you had to be selective, and investors were. And same goes about Ukraine. There's a lot of awareness of Ukraine's reform success. You don't have a single day on when the London-Kiev flight there's no investors. There's every day that people are coming, and Yuri and the team and all the highest level officials are available for meetings, and then they go to conferences, including this one. There's a huge awareness, in fact, and again, in defense of investors, they are overweight Ukraine, so they have more Ukraine than they should have had versus the index. I just think that, again, I just only have to repeat that you have to have more...
The index is also wrong, of course, because it's not GDP weighted. It's just an absurdity to measure everything against... Sorry, I'm just trying to be provocative,
fair point.
Stir it up a bit.
But I'm
Let's
just saying...
have GDP weightings, please.
So I'm saying that investors are becoming wiser. They're becoming more immune to the noises, as Jerome said, the whole tariff war, and so on. They're becoming more aware that that they actually should focus on the underlying stories.
Jonathan, Neill, this awareness of Ukraine that Mikhail is talking about, do you encounter that in the family offices that you speak to, or is it a very much educational conversation you need to have with them that you start at square one?
Okay, there's a few things to say. I need to pick up on some of the other comments, if I may, first, before I answer your question, because there's quite a lot going on here about indexation, the sort of manias of it, the flaws in it, the faults with it, and so on, and the difficulties. I would like to talk, actually, the first thing to say is the difficulties of many managers to outperform an index which is performing much better than they are. And this causes enormous problems for active fund managers, of which I'm a great proponent myself, having been one all of my career. And you find yourself at a certain times when actually you're finding it very difficult to outperform the benchmarks. Now, it's very easy philosophically to say how lopsided they are, how dangerous they are, that they have more and more weightings in bigger and bigger loss-making companies. But if you're underperforming those benchmarks as an asset manager, you have a real problem. And many, many, many asset managers, I think first of the US and then I think of Europe and the UK, you get the allocation wrong. And it's okay for a bit. The clients, they bear with you for a while. They can suffer 1 year, 2, 3, but after 3 years, your business, you're finished. And I know many companies who, for example, in the late, I'll just give you one example, then I'll come on to your question. If we talk about the late 1980s, when the Japanese market was going from strength to strength, even after the crash of October 1987, which many people, including myself, thought would be provoked by a collapse in the Japanese stock market, it fell, but then went further into much higher ground to the end of 1989, at which point that country represented nearly 60% of the IFA index. So it was enormous allocation. And it went on going up much longer than anybody thought. Most people, most Western managers underweighted that market in their portfolios, thinking that Japanese valuations were insane, which they were. But they became more insane, and it went on in Korea and in Taiwan, both of the same countries, both at the same time. Completely insane, went way beyond anything you'd ever dreamt of. Market valuations reached 20 times their book value in South Korea and Taiwan. So this was a very dangerous thing to do. So I say that for the active manager, being underexposed to well-performing assets is very, very dangerous. And you're seeing it in the US as we speak in the last few years. Now, as for Ukraine, I'm an investment manager. We have investments there. We have bond investments there. I think the stock market is too illiquid really to be taken seriously by big asset management companies in London. It's a specialist market. It's a frontier market in the classifications of the Morgan Stanley. So it's a sort of connoisseur. It's a connoisseur's market, right? It's for the specialists. It's for the debt people who know what they're doing, or most of the time, some of the time. So I would say for us, for talking to institutional clients around the world, it is, if you start off the meeting by mentioning investment in Ukraine, you're probably down 15 love just at that moment. If you go on a little further and then talk about Russia, it's probably 30 love. And you then need to you then need a couple of good serves to get back on track, to get people on side. So it's not the first thing you want to bring up in your conversation with the investor. It's something that, as I say, for the connoisseur, it has many opportunities, and people here are much better qualified to speak about it than I am. I know a little about it. I've been here several times. But yes, it's a country with many opportunities. It's indebted, but not much more than many other countries. I've been looking at the metrics on the way here. So it has many problems which are endemic, which can be changed. And the one other thing I wanted to say, when you have sort of Turkey, Argentina taking up a lot of the headlines, and Argentina following a more conformist pattern, or at least having the support of the Western institutions or the IMF, is very different from a Turkey which doesn't, where you have a regime which seems violently opposed to the treatment suggested by the West. So the markets are obviously going to look more kindly on the markets which follow more orthodox policy. If that answers your question.
If we take your tennis analogy,
yes, sir.
What would it take for the umpire to shout, "New balls, please," and we enter a new period in terms of reforms in Ukraine, for it to move from a connoisseur's market to a more mainstream?
Yeah, absolutely. I think, without wishing to be disqualified or fined or to lose a game or a match even, or the US Open final, I think to have a government that was open to Western capital, which of course it is, and to pursue that by the privatization. I think that's probably, I don't know if you've spoken about it on this panel, but on other ones, the privatization, therefore the liquidity. I know Jerome was talking about liquidity didn't really matter, but actually it does. It does matter a lot. When you're stuck in investments from which you can't emerge, it matters a great deal, and 2008 showed all over the world, actually assets which you thought were liquid weren't. So a liquid stock market, the privatization of core assets. In fact, Mikhail was speaking yesterday about the land, the value of the land, you know, which could somehow be monetized, turned into something that people could invest in. That would bring in huge amounts of capital. You know, those of us who studied history know that the Ukraine was always spoken about as this basket, you know, the bread basket of Europe. Or whatever. You know, it was incredible, and you fly over it. It's a fantastically fertile country, and yet I notice actually looking out of the window on the flight from Warsaw, the difference in the land, just from the air, of the land in Poland, and then when you go to Ukraine, you almost knew the minute you had crossed the border, even though there isn't a line, because it was somehow not kept so well. And you noticed immediately that, even from the air. So I guess investment in that, liquidity, privatization, and the development of a pension fund system in the country, which would allow local pension funds to invest in projects and in the debt markets and in a fully functioning equity market.
Jonathan's talked about the privatizations and the, I mean, just up the road from here, I think the Preportowy Zawod, which the government really would like to privatize, but it's caught in a limbo where I think there's money owed to Dmytro Firtash, who's holed up in Austria. And I mean, how can we move ahead if some of these major assets, they're just caught in this limbo and it's impossible to move them?
Well, I can tell you my point of view. We are not intended to privatize the Preportowy plants, but just as in my view, the government is not always a bad owner of the assets. The approach that the government or the managers that can be hired by the government can be similar to the approach of any other shareholder. As we discussed yesterday on the panels, the country is, let's say, the company with the shareholders, either people or elected representatives of those people. So therefore, I'm not sure whether we really need to, okay, everyone wants to see some signs of privatization. It's so popular, it's the trend. But I'm not sure that we really need to do it right now in the current circumstances, rather than hiring appropriate outsourcing companies, the managers and so on, and that create conditions for its development. And other than that, well, maybe it makes sense to keep it for a while.
If I may chip in, I'm sure we have now a session just going on in the next room on privatization, and coming back to the question of what needs to be done for Ukraine to re-rate in another league in the tennis, right? It would certainly have to maintain the continuity of its current policies, both on the monetary and the fiscal, for which they've been commended so many times. I guess in the current conditions, with the current indebtedness levels, relationships with the IMF are crucial as well. And then, if I were to name the next single biggest thing, I would say land reform. Just repeat that. The land is already kind of privatized, and millions of people kind of own it, but they can't do anything about it. They're just being paid minuscule leasing rates on that land, and they can't really sell it or mortgage it or anything like that. So I think the single biggest thing, after maintaining fiscal, monetary as they are, and keeping in good relationships with the IMF, I think the next biggest will be the land reform.
But Yuri, the relationship with the IMF, which Mikhail was mentioning, every year we have a similar story. The IMF comes, we're waiting for their assessment and their blessing. I think we're still waiting for the report to be issued now. That are we always a distressed economy here, waiting to be rescued by another tranche of handouts? Can this carry on indefinitely? I mean, surely investors now just see Ukraine as a one-trick pony joined at the hip with the IMF.
Yeah, I think so. If to answer simple this question, which is not easy, obviously from the investor perspective, IMF gives them a safeguard pretty much. They understand that once you are in the program, that somebody else is checking and doing the job and looking that okay, everything is fine and everything in the program, right? So from one side, it's positive for us, and definitely all the relation with IMF is positive for us, because without them, I don't believe we could achieve that much we did in the last 4 years. And but from one side, obviously, you have the proxy there. So nobody looks at underlying numbers. If you talk to investors, the first question you always get is about IMF. So we know what we have to do now from one side, right? We know that the upside is coming from the positive from IMF, and that's where you concentrate. But once again, so people get lazy with it, you know. So people just don't look at this. I mean, investor community, they don't look at more other aspects of the economic or other things which are not covered by IMF program, because obviously IMF is about monetary fiscal. Okay, in Ukraine it's also about a lot of anti-corruption infrastructure and governance, which is also very important. But it's not about like private sector development, you know. It's not about FDIs. And I would just I liked Mikhail's colleague yesterday, who said that basically the three types of investors you are working with, and those are who go to local capital markets and those who go to international bond markets and invest there, and both of those are rather easy to turn around and go back if something goes wrong, both with you or with the market in principle. And look, as Jerome said, for something they believe is less risky assets, which might not be the case in the end of the day. But the thing which, and that's what just Mikhail said, and what we need to work on, and that's not something IMF is designed for, but that's something what the government should concentrate on, is actually FDIs. And the privatization is a part of the story, because those investments come and they don't go that easy. You know, they stay in the country. The same story about the land reform. Land reform is not only about the freedom of ownership of land and people like transferring them and the farmer developments, which is a very important aspect. But also, as Konstantin said yesterday, it was Makar probably, who said yesterday that we actually are not that effective owner of 1/4 of the land in this country as a state. And just simply selling this state on market price, it's huge for the economy and it's huge for the budget as well. So that's something I think which another part of the story we need to concentrate on, which is not that much on the fiscal or monetary, but it's definitely something for the economy to develop further.
Jerome, you've seen land reform happen in other emerging markets. Is it a real game changer for you?
Well, yes. I mean, Hernando de Soto wrote about this, and you can go to cities where you have a road. On one side, you've got property built up and clearly prosperous, and you've got a shanty town on the other side of the road. And the difference between the two is that the shanty town occupants don't have legal title to their land. And the profound point that he makes is that the moment they have that legal title, they can borrow against that. And with that money, they can buy a sewing machine, and they can create employment for themselves and their family. They can create real wealth. They can generate, in a very real sense, the legal process of title creates capital. It's a net creation of capital, in real capital, creating productive activity. So there are two, I mean, we're talking here about agricultural land, but there are two important functions that a foreign investor, why you might want a foreign investor. And we need to, in a way, get away from the first and more to the second. The first is, well, we just need the money. And that's kind of where Ukraine is a little bit. We just have to pay the debt, and we need a way to make the maths work. The second is to signal to pools of domestic savings that actually, if a foreign investor with all their difficult questions and independence of mind is happy to invest in a stock market, in land, in wherever else, then that is signaling to everybody else, actually, they've done the DD, this is actually okay. And there is a period of development where that in any country can become very, very important. And once domestic savings are built enough, then you don't really need foreign investors. I mean, actually, a lot of emerging markets are now in that point, which is part of the reason why what happens in the US is irrelevant to them, because their domestic economies are huge and they have domestic savings base, which is institutionalized, and they're completely independent. Ukraine's not there yet, but it should be welcoming things like privatization, land reform, not just about, who can manage the thing better or can we raise some money. It's actually a signal to domestic investors, institutional investors and individuals that there is an investable asset there. And that in itself is very valuable.
Hernando de Soto also told us last week in Kiev that trade relations can overcome most wars. Mm-hmm. Is that the case with Ukraine and the conflict in the East?
Well, it's a positive-sum game, trade, and there's a very good book actually by Jane Jacobs many years ago, which is a sort of platonic dialogue between the public and the private sector. And there's also, if I was giving a reading list, there's of course Matt Ridley's Rational Optimist, and there's a number of other books which are really build on this point that commerce is entered into and trade is entered into by parties, both of whom have a benefit, and that creates linkages. I always say when people talk about putting sanctions on the country, well, the best way to prop up a dictator or authoritarian is to cut them off from the outside world, because then they have more control over their own people. It's just a nonsense to think that that's an intelligent pressure point. And of course, sanctions almost never work unless they're completely universal. So I think some of the things going on in the near neighborhood and some of the behavior which is geopolitical is just ill thought out. And unfortunately, Ukraine is on the brunt end of a lot of this very muddled, very outdated Westphalian, as in the Treaty of Westphalia, 1648, idea of territoriality. And really, we need to move away from that to a different way to conduct relationships between countries. And yes, trade, commerce is absolutely crucial to building domestic support for peace and prosperity and economic activity and stability. And that is a really important, and it's linked very closely to the earlier comment, actually.
And this geopolitical turbulence in this neighborhood that Jerome's been talking about, Oleksandr, Metinvest has been the biggest victim of this, with your factories in the east being seized by Russian proxies. Yet you've taken that really big hit, but you've managed to go back to the market to restructure in a volatile market environment and to return to debt capital, to improve ability to lend. Can you give us a bit more background how you achieved this?
Well, I think the best approach here is to say that the victims are people at the end. So it's like the people suffered. The business is just the second line of this whole story. And I think that people are still suffering all over there. Regarding the assets, we had quite some time where it was not definite whether we can operate or not. And I'm pretty sure that it's not about whether we can and what are the metrics. I think it's all about morning press when the person in London or US watches the TV that says like, okay, it's bombing and shelling. Therefore, people are simply withdrawing their investments, not just because they do not trust into the company. They just don't want to hear and listen all this stuff. And like we've discussed, like they just start investing into the Turkey that at that point of time was much more stable, straightforward, and so on. And having said that, I think that a lot of assets were done together with the government. Not of them were all very successful. Some of them were. I think that we still do not have any incentives or something like it from the government. We didn't have much of the incentives or excuses from the investors and the lenders. And I think one of the things that actually played in our favor is that we never said, okay, give us like haircuts or whatever. We just like did our job. We said, okay, it is difficult, but we need some more time. The time has come. We can never avoid the situation when let's say, the current environment in the East might deteriorate. Well, this is unpredictable, but in the current circumstances, because of the war, the company became stronger. I think the economy of Ukraine became stronger. We still have lots of things to do with the infrastructure, and therefore we are here asking our IFIs so that to continue investing into the country, and the Ministry of Infrastructure and Ukrzaliznytsia to continue improving their performance and managing all this stuff. So, and I think that Ukraine has developed. It is bad and sad, it's a bad experience, but we managed to overcome it, from my point of view, to much extent.
And we have the logistics problems now with the Black Sea and the Azov Sea, with Russia restricting movements of goods. Is that a serious problem for you as well?
Well, first of all, we don't have a problem with the Black Sea, thanks God. I think with the Azov Sea, there is a technical problem of the Kerch Strait and its height, so definitely there was and is a challenge there, but it was technically resolved with the owners of the vessels, and the company duly redirected part of its deliveries through the railway, but we're still doing a lot with the Azov Sea. Regarding the situation of control from the Russian Federation in the Azov Sea, this is something that, I mean, in the normal circumstances, it can take like 1 or 2 days. In the current environment, it can take a couple of weeks. Well, definitely difficult to comment what's going on further, but for the time being, we are importing through Azov Sea, we are exporting through Azov Sea, including to United States and so on. So, and I think that we need to develop the railway at the end, because if we develop the railway, it would be even more safer for us in future. But I'm pretty sure everything will be fine.
And what, how do you judge this new environment, Oleksandr? Your boss, Mr. Akhmetov, Mr. Pinchuk, the rival oligarch who owns Interpipe, a lot of their assets are have essentially been reduced to distressed investments for one reason or another. Are we finally seeing a sea change, a de-oligarchization of Ukraine's tightly held old school economy to involve a much larger number of players and actors?
I like this question, thanks. Well, first of all, I will probably not comment on Mr. Pinchuk, although I'm much aware of what is going on there and so on. And really, it's the market and investors to comment, and they know for sure who does what and in what way. And therefore, I can only comment for Metinvest, being the purely commodity company, not having any incentives, refunds from the budget. As of the beginning of the crisis, the debt of the government in the early 2014 on VAT refund and income tax prepaid was over 400 million, if I remember, dollars. And due to devaluation, everyone was saying, wow, how much Metinvest won, but everyone forgets that how much Metinvest lost. So from these points of view, I don't think that the word of oligarch right now can be attributable to the market company, commodity company like Metinvest. Mr. Akhmetov, by the way, he has a birthday today. So, well, he's probably the person who is transforming his attitude and view of the business from the past into the current market. And he's developing like any of us, and he's transforming, and I guess that SCM Group as such is the biggest taxpayer in this country, so and the biggest local investor. So I would doubt to say that, well, there are some things, and it's really to the market to discuss, but with regards to the Metinvest, this is a commodity company that is exporting goods and depends on the global markets. So nothing to do with the oligarchs or something like it.
Mikhail, do you ever see companies in this region going into distressed status when that isn't totally necessary?
Shareholders and management often behave what we politely call opportunistically. So when they see a chance to create some shareholder value by haircutting credit investors, they sometimes do that. And otherwise we've also seen a few episodes, unfortunate episodes of mismanagement of some agricultural businesses in Ukraine, where investors we're left with very low recoveries. So the short answer, and it's not Ukraine specific, by the way. So I guess put it like framework wise, when the company loses hope, or a bank, of returning to capital markets, that is a turning point, like an inflection point where they can completely change behavior, and from being nice, that can be very unpleasant. But until they believe they can still be coming to the capital markets, they behave well.
Maybe just one comment what Mikhail said. We have the former shareholders of Mria who are not the oligarchs. At the same time, the result is that there is a huge haircut. The guys have stolen the money. And for example, in case of Metinvest, the shareholders, being the oligarchs, have met the requirement of the investors, pledged the shares, made the restructuring, honored duly the obligations, and in 1 year time, the investors returned to them and they made the refinance. And there is no share pledge whatsoever, but it was the decision made by the investor, the local one, who really want to stay in the country and want to develop it. And this is the difference. And it doesn't really care whether it is oligarch or the businessman or whatever you call this person.
Do I have any questions from the audience at all? Any burning issues you'd like to share with our panelists? Yes, a gentleman here in the second row. The microphone is just coming to you. Please state your name and company.
Is this working? Yeah, hi. I'm Jim Brook, Ukraine Business News. And I kind of some questions left over from Jerome's very interesting discussion. There is this, and I lived in Brazil for 10 years. The U.S. catches a cold, Brazil catches pneumonia. I mean, there still are some of these linkages. Now, you've said they've been broken, but in case of a relatively small economy like Ukraine, EU catches a cold and Ukraine catches pneumonia. I mean, if you could elaborate a little bit on the differences there. And also the weight of history. If you're Henry Kissinger, you look at your backdrop and say, well, the Russians built that. They founded Odessa 200 years ago, or they ruled the Odessa for 200 years. What we're seeing now is a blip of history. What those of us who live here see, obviously something new is being created in Ukraine. And how do you weigh the weight of history on your future investment decisions?
Yes, I mean, I think there's a difference between real economic shocks, which affect one's economy, and financial market shocks, if you like, on the one hand, which can overemphasize that, and what I was really talking about, which was systemic risk, which spreads from country to country. So I think the economic linkages between Brazil and the United States are actually quite small. I mean, Brazil is about 10% of Brazil's trade. So, they trade much more with the EU, much more with China, much more with Mercosur. And I'm really not sure that the real change in Brazil has been, that they have now a very large domestic savings base. So I really don't think that the links are anything like they used to be. And Ukraine, and yes, but there are real economic linkages. So insofar as there's a real economic linkage, then yes, there is a serious knock-on effect. And I think investors in Ukraine have to be very, very aware of those linkages, particularly as Ukraine is, if you like, where a lot of emerging markets have been, which is relatively vulnerable to external shocks because of the financing needs of the country. The second question, and you mentioned Kissinger, of course, I mentioned Westphalia earlier, and of course that's his worldview, very much so. History is enormously important, and it really does affect people's sense of identity. We're in a situation now where, of course, the nation state has developed over many, many years, and there's a very good book by Philip Bobbitt called Shield of Achilles on this, which really describes the different types of nation. And we've gone a long way from a an individual, a citizen, having a simple or single identity. We all have multiple identities, multiple affiliations. But this doesn't mean the end of the nation state. It just means it becomes more complex. And history is important in lots of other ways for an asset allocator, because it helps us understand the motives, the incentives, not just of decision makers, but through them to their electorates, their pressure points. And I mean, one way to express this is that if my job for 20 years was buying and selling countries, basically, and the easiest decisions were often the biggest decisions. When you have a crisis and the president or the finance minister only has a limited number of choices, and when there's a real time limit, that's when you get the easiest calls, when the biggest things are happening. And the way to analyze that is to understand what their choices really are in the setting of their political setting. And history, determines how, they're going to relate to their citizens, their electors, their peers, and that determines policy choices. So as an investor, that's a very, very important part of understanding this. In terms of the wider geopolitics, I mean, we could go on and talk for hours about Eastern Europe, but I think from an investor point of view, that's the most important thing, to try and have history inform us about people's incentives and worldviews, which in turn can shape future history, the future.
Thank you very much. Thank you for your question. Do we have another question? Yes, a gentleman here in the fourth row.
Hi, Giles Farley with ICU. A question for Mr. Galkin, Mr. Booth, and Mr. Neill. We talked a little bit about ETFs and passive investing, thinking about the broader market space, and I'm interested on your thoughts of whether these passive flows have increased the valuations for large companies, essentially created winners among the larger companies worldwide, and what are the implications of this trend of passive investing, which I believe is continuing to this day as these huge flows come in, the next time the world economy freezes up and there's really a major crisis as there was in, say, 2008. Thank you.
Who would like to start? Jonathan, please do.
Can I say something? Yeah, I think I think it's probably the let's say the enthusiasm for the ETF, or is it now become it's probably become a mania now. I think coming back to what I said before about the difficulties of outperforming indices which are full of very large companies doing well. So I've seen the last numbers that I have seen that 85% of US managers had underperformed over 10 years. It's an enormous number of active managers. There are thousands of them, by the way, all doing worse than the indices. So yes, why bother with active managers when we can buy an ETF for 8 basis points? Is it 6? Is it 5? It's naught, actually, or is it soon going to be negative? They're going to be paying us to buy the ETF. So this, to me, was a sign that they had reached the end, when Fidelity said, we'll now start doing them for nothing or even paying you to invest in them. This is it. So there are times, though, when the markets anoint a number of companies with the crown, and these are then the things that you can only own. We've seen it many times in history, and you're all very aware of the Kodaks and Polaroids and things, which, by the way, don't exist anymore. Just to remind you of that. These were two of the nifty 50s and 1960s and 70s. So IBM also, by the way, another one, actually a sort of shadow of its former self, one of the worst performing stocks in the now defunct Dow Jones Industrial Average. Absolutely terrible investments 30 years later. So for the active investor, they need to be careful. Like, I can see that the ETF has a place in most portfolios, and Warren Buffett tells people this, and other people who manage ETFs obviously tell them that from ETF managing companies. So yes, but the time will come. The time will come when these things will do less well. They will do less well. How will they do less well? I don't know, by markets treading water for some years probably is the most likely thing. Therefore, giving the active managers the chance to show actually that we are worth having in your portfolio. It's worth paying a bit more to have somebody who thinks. Jerome talks about people studying history. Don't forget, people should study literature too. Literature really analyzes the way that people think, that we don't often, we don't have time to review it as much. So the great writers, they study the motivation of people. What is it? This is also important for in an asset management company, as well as historians. You need people who study literature, people who think. The ETF thing has now become a dangerous phenomenon. It's become so dangerous that it's talked about in government circles. So they know that the next time there's a big financial shock, these are the instruments that will probably the liquidity may even dry up in those. And there are so many of them. There are so many ETFs for everything you imagined, and many you probably didn't. There are thousands, probably more than there are listed securities in the US. So they're dangerous. It has reached, in my view, full recognition, full acceptance, and they must now be treated carefully by investors. That's my take.
That answer was a journalist's dream. I mean, how much information you crammed into 1.5 minutes was deserves a prize, I think. But you say that ETFs are a mania, but then again, you would use them to get into and out of markets very quickly for Argentina, for instance. So they're a very useful tool for you.
Yes, they're very convenient. I can't deny their convenience. I want to buy Argentina today. I buy the ETF. I want to buy Turkey. It's very convenient. I don't deny it. But that's probably for a trading instrument. You know, I could easily buy some ADRs traded in the US if I wasn't sophisticated enough to have the settlement set up in Argentina locally or in Turkey locally. So yes, they're convenient instruments for traders. And for investors, I don't know. I don't think, I mean, we're talking about different groups of investment people now, and this comes back to, you know, the herd or the herds that Jerome refers to, those people whose assets move quickly from one place to another, the hedge funds who buy Ukrainian debt for on a carry trade for a short period of time, and then the people you really want to buy your debt, which is the pension funds of the local authorities in the UK or the mainstream pension funds in the US. These are the people you want as your bedrock investors. The people who buy the ETF tonight and sell it next Thursday, these are of no use to anybody.
So they're dangerously convenient, I think is the point. I mean, I'd agree with everything you say. I mean, the only thing I might add is that, because I think you're spot on, is, you know, we have to ask ourselves why are so many managers underperforming? And I think part of it is because they actually still have a lot of pressure to watch the indices the whole time. And so they don't maybe take some of the positions and the stronger views that they should do. And they're a bit cowardly about it. And so it's the curse of the indices, and you know.
I've got to say, but when you appoint a fund manager, every fund manager has to be given a benchmark. You can't just appoint a fund manager, just go off and do whatever you like. Even they have to be given the benchmark of, you know, some money market return or something. Yeah. Every manager must have a benchmark. A US manager must be managed against the S&P or whatever it is. And if you do badly against that, you know, you can moan all you like about the inconsistencies and inefficiencies and distortions of the index. You are underperforming that index, therefore you have to do something about it. You have to do something. You can't just say, I'm right, they're wrong, I'm right, I stand on this side of the road. It's the wrong side, by the way, and you get crushed by a truck coming the other way. So you've got to be on the right side of the road.
I think that's...
So we have to be flexible.
No,
Managers have to be flexible.
I think where I've had success in persuading these mad ideas, you know, persuading investors to actually not look so much at indices, and I have had some success, has tended to be with very, very large investors, sovereign wealth funds, etc., who take a very long-term view and do scenario planning and do things strategically. And you know, there are central banks that have, and sovereign wealth funds that have very, very simple benchmarks based on total return. They do exist. And but the whole way of getting there requires dispensing a lot of, you know, our bread and butter thinking about asset allocation. It's really quite radical. And, but it is happening in pockets. And all I would say is that this isn't, you know, this is a job for all of us collectively. And if we you know, have an end investor who, you know, we think it's impossible to persuade them to do anything other than the way they've done it, then, you know, we have to go along with the traditional way of doing things. But this is therefore also a question for policymakers. It's also a question, you know, for the end savers, whose interests are often not being best represented by a mania for indices and very short-term time horizons when their liabilities are 20 years. And I think, you know, there's a big policy issue here, and there's a big education issue. And it's a very, very difficult task, and there's no question about that.
Do you agree, Mikhail, that exchange-traded funds, as your colleagues say, are a manifestation of cowardly capitalism?
Look, it's all about the pressure. Fees for active managers were high, so ETFs are basically making it, fee-free almost. But I just wanted to argue that at the moment, for emerging markets at least, ETFs are not a huge disruption yet. And by the way, where I started by saying that this year was phenomenal in EM in terms of how the differentiation between the countries' performance. ETFs this year are going to be doing much worse than active managers, and this is the year where active managers and hedge funds will prove the point finally that it's not all good with ETFs. And my second point is that at least within EM, and again I'm just talking EM credit, ETFs are still a drop in the ocean. Yes, they've grown exponentially, but their base is so low. Like the biggest ETF is now $10 billion. Like we're talking about an asset class of $3 trillion. So, and final note, if and when ETFs become more disruptive, again, it just creates amazing opportunities for smart and humble investors. So it's a source of disruption, but it's also a source of price inefficiencies that will be created and have to be taken advantage of.
Sorry, I think there's another relevant point here. I think one of the reasons why for the last 10 years ETFs have done well is because of quantitative easing, to be quite blunt. The extraordinary monetary policy that we've had has created an artificial stability in Western markets. And if you believe that's going to continue indefinitely, I mean, Mark Carney commented recently that he expected the sort of pattern of interest rates to exist in his lifetime. And I don't know whether he's been to the doctor recently and has had a nasty surprise, but I hope not. But that's, I think, a rather telling remark about, with reference to financial repression I was mentioning earlier being the objective. But I think it's also very unlikely that he's right. I think it's much more likely that we, having had a period of 10 years where we've had everybody's breath being held and hoping that nobody's going to say the emperor has no clothes on and desperately trying to weave some clothes for him, and we've done some of that. The fact that we haven't even recapitalized European banks properly yet after 10 years is, of course, a weak point in that argument, but we have done a lot of other good things. But the era of sort of smooth, uniform intervention by central banks to smooth over markets, bolster markets, buy securities, that has to come to an end at some point. And when it does, then structural shifts will start to appear. We're actually entering a dangerous period as rates are normalized right now. This is a very dangerous period as we think we can stop this very peculiar, and it's got very negative side effects to asset allocation, to allocative efficiency, as I said. Once we stop doing that, we are back in the world of country differentiation, of big structural sudden shifts, of vulnerabilities to the overshooting of markets. I don't think it's any surprise that the strategies of front-running the US Treasury market, of a particular very large bond manager in the States, for example, which I couldn't possibly name, that strategy, which was so successful up to 2008, suddenly became not successful. And I think there's a very good reason for that, because the Fed is also in the trading room now. And that has a very real impact on the dynamics of bond markets, and as a result, I think it has all sorts of implications for global markets.
Can I say one thing? I have to go to get an aeroplane. Is that for all the quantitative easing, which has pumped up the value of many assets, but by no means all assets. No. Let's be quite clear about that, and let's be quite clear about this year to date. This year to date, in stock market terms, at any rate, let's talk about bonds, is that the US market has been at the front running, and actually many companies which have driven that market performance have been loss-making. There's a very interesting article in the Wall Street Journal yesterday. Maybe you saw that. It's a slightly worrying sign that the great big loss-making companies, not all of them, them, have been part of the driving force of the US market. So that was a worrying sign that we saw in 1999-2000, which didn't end well, by the way. So the QE has not actually supported other markets. I'm not talking about since 1999 from the low point in March, obviously not. I'm talking about now, more recently. Emerging markets haven't really benefited either, by the way, given that they haven't moved since October 99. I think probably the index probably hasn't moved at all. So all the benefits of QE, probably this is Jerome's point, that emerging markets are representing great opportunity now because they haven't really performed very well. The risks are discounted, perceived wrongly, yes, absolutely. But the markets decided actually that what they want is the US. What they want in the US is that, and that will go on until it stops. And then it will stop. It may sound very simple, it is, but we don't know when it stops. And our job as managers is try to work out when that stops, what we're going to do about it, what's going to make it stop, why will it stop? And I will stop.
And now that you've advertised our competition in the Wall Street Journal, I'm going to have to mention an article in the FT as well. A couple of days ago, Ukraine's former finance minister, Daniluk, was commenting on the Court of Appeal views in London, where Ukraine's dispute with Russia over its $3 billion Eurobond, the so-called Yanukovych bailout bond, where the court's initial summary supports Ukraine's position over Russia. I think the former finance minister, I believe he was here yesterday, he described this the first time in the cold-hearted world of finance that geopolitical and ethical factors affecting the relationship between two sovereign states is playing a decisive role in sovereign debt restructuring. Oleksandr, what are the implications of such a major decision?
Well, I would prefer not to comment. But, you know, like, we all discussed that the creditors should be somehow in the same way like the borrowers. So they should the rights in Ukraine, outside of Ukraine. And the only solution for resolving any situation is the court. Metinvest and its creditors were in the court as well, although it was more, let's say, friendly, cooperative approach, pushing some of the really minor 1-2% of the investors who were destructive. Other than that, whatever the decision of the court could be, it should be fulfilled. So whatever the final decision of the court will be, each party should fulfill it. So this is very straightforward. I don't know whether it is right or wrong, whether it is correct or not, whether we should return or not. This is the court to decide. If the court decides, we should follow the route of the international markets and the legal way.
And I've got a final question for our panelists before we wrap up, because I think that they're brewing up some tea, and for the British contingent, I hear they've got some tea with milk, a final Brexit cuppa that they can have there, and some traditional tea with the jam for the Ukrainian investors as well, and maybe some espresso for the Americans. And I mean, there is an old Ukrainian saying, I think from the Western Oblasts: a man can have a good horse or a beautiful woman, but never both. Now, is it too much to hope for a European-facing country with high-quality investors and also peace in the East with Russia and a return to territorial integrity? Is it too much for us to hope for both?
At least from our side, I think that's something we definitely have to and want to deliver. But obviously, it's not the world of miracles, so never happens like at the same, everything happens good at the same time. So it's a tough job, and sometimes you need to pick your battles. You cannot win all of those. So we cannot obviously win some of the real battles, but we can win some of economic ones, and that's the ones. I liked yesterday Chinese part in the morning. It was incredible how the war strategy was described, when basically you don't hit 10 fingers at the same time when you have like enough power only to hit one. So you pick the finger you hit, and you hit it really hard. So that's actually, once again, for a small open economy as we are, that's probably the best tactic to go forward.
I think Kennan warned the US and the West in 1991 that the consequences of Westphalia-type thinking and creating a new antagonism towards Russia was a very dangerous one. And I think, Ukraine is obviously caught in the middle. And the answer to your question is changing the dynamics.
To be fair, James, Ukraine hasn't been antagonistic towards Russia.
No.
In any way, shape or form.
No,
in its history.
It hasn't, but there are different points of view coming from Russia. But if the question is there a scenario under which you can have the horse and the woman? I think the answer is yes, but it involves everybody else involved. It involves your neighbours and your relatives and your mother, your future mother-in-law, and everybody else has to get on. And I'm afraid that is a big task, and it does require a rethinking of East-West relationships. And I think that's what my answer is. I think we are not there. But it's definitely something we can hope for, which I think is your question.
My answer? Sell the horse.
And Oleksandr, it is in the plan to get the factories, the plants. There's legal action being taken, I believe, against those who are illegally trading commodities in the occupied territories. The strategy will be to get those back under Metinvest control.
Well, legally we are still the shareholders. Practically we have created all the provisions already in 2017 in both P&L and tangible net worth and all the other aspects of IFRS accounts. Practically, yes, there are some issues regarding the sales of the products that are produced there towards the export outside of the Russia, but my understanding probably is the most of it is being sold in the territory where they're located or in the Russian Federation. Legally, we don't have the facts, or we do, it depends on the straightforward process on the legal side, and depending where we can go to court or not, it depends against whom. So this is very straightforward. But maybe I wanted to comment regarding the future. It's not about to get the target of reunion or, of course, idling the process in terms of war actions and so on. This is, of course, the most important. But we should think about it, what we want to achieve at the end with those people, with our people here, with those people here that are all, for the time being, are citizens of Ukraine, and what we want those people to expect from us from them, or we shouldn't expect at all, and we just should care only about some geopolitical, practically technical issues. Just stop reunion and what's that? It's about the future development, what we want to do with children, how we want to grow up them, for them to be in the citizens of Ukraine, rather than to have any circumstances, uncertainty in future, because it can happen any time in future if you do not change the education, the grow up and united the nation as such.
Well, thank you very much for that very positive finale there, Oleksandr. And ladies and gentlemen, you've been a great audience. Thank you for your questions. We'll retire for half an hour for a much needed coffee break. Thank you very much. Please put your hands together for all of our panelists.
Дякую, пане та панове. Це була дійсно цікава панель. Чекаємо вас за 30 хвилин тут, у залах. Нагадаю, що в нас буде дві паралельні дискусії, які будуть відбуватись одночасно. Тут у великій залі Віндзор буде тема блокчейн, можливості та загрози для криптовалют в Україні. У малій залі буде панель за темою